Are you looking to grow your wealth with investing, but don't know which route to take? Do you want to maximize gains while minimizing losses? The stock market can be quite complex at times, which is why it's so important to choose an investing style that will suit your personality and the goals you want to achieve. Growth versus dividend investing is probably the most popular debate when it comes to choosing an investing style. On the one hand, growth investors look for high return on investment, while dividend investors look to build passive income over time. Both strategies have their merits, but which one is right for you? In this video, we'll be discussing the pros and cons of each approach to help you make an informed decision. But before we start, make sure you like this video and subscribe to our channel for more awesome content. What is dividend investing? Dividend investing is when you invest in companies that pay a dividend. But what's a dividend, I hear you ask? Well, a dividend is when a company will choose to share its earnings with its shareholders. This dividend is often paid out quarterly, but can sometimes be paid out biannually or annually depending on the company and how they choose to distribute their dividends. For example, if you invested $100,000 into a stock that had a dividend yield of 3%, you would receive $3,000 per year, or $750 paid out each quarter. It's important to remember that on top of the dividend payments, you can also make capital gains as well if the stock price rises in value. So what can you do with your dividend earnings? Well, you can use this money to buy more shares of the company, or you can take the money out and do whatever you want with it. Dividend investing is very popular and is a great way to build a passive income stream. The main idea behind dividend investing is to invest in companies that pay dividends regularly. Most companies that pay regular dividends tend to be stable with lower growth potential. Some good examples would be Johnson & Johnson, whose dividend yield is 2.55%, or Coca-Cola, whose dividend yield is 2.81%. When looking for dividend stocks, there are a few things you should keep in mind. The company's dividend history is a good place to start. You want to make sure the company has a history of paying dividends and that those dividends have been increasing over time. You should also look at the company's payout ratio. This is the percentage of earnings that the company pays out as dividends. You want to make sure that the payout ratio is sustainable, meaning the company can continue to pay out dividends at the same rate going forward. Other factors to consider include the company's financial stability and its growth potential. So let's go over the pros and cons of dividend investing. Pros of dividend investing. Dividends are extremely passive. Once you buy the stock, you can simply sit back and collect your payments. Companies that pay dividends are often more financially stable than companies that don't. This can make them a safer investment. You can reinvest your dividends to buy more stocks, which can help your wealth compound on itself over time. Cons of dividend investing? Dividend investors are looking for stability and slow, steady growth, which can limit their potential for capital gains. It can take time for dividends to add up and generate significant income. You need to be patient if you want to invest in dividends. Dividend stocks typically have lower returns than growth stocks, as the focus is more on income rather than maximizing your return on investment. Your dividends will be taxed, so whenever you receive a payment, you will be liable to pay income tax on any amount you receive. So, who would suit dividend investing? Dividend investing is a great option for those who are looking for an easy long-term strategy to build wealth over time. The companies you will be investing in will mostly be stable, and if you diversify your investments, you could end up receiving dividend payments every month. It's also a good strategy for people in their 50s or 60s. If you're closer to retirement and you already have a large amount of money saved up, dividend investing could be a great option for you. This is because if you invest in dividend-paying stocks, you would be able to generate a consistent stream of income that you could use for when you do retire. What is growth investing? Growth investing isn't done with the aim of receiving regular dividend payments. Instead, this strategy's focus is all about investing in companies that are growing fast. Why? Because fast-growing companies have fast-growing stock prices, and growth investors aim to profit from the capital gains of these stock price rises. The main idea behind growth investing is to invest in companies with good fundamentals and a strong potential for future growth. These are usually younger companies with innovative products or services that have the potential to become big in the future. Most of the growth stocks you see today tend to be in the technology sector, because this is one of the fastest growing sectors in the entire stock market. While this investment style does come with more risk, as most new and unproven companies do, it can be incredibly rewarding if done correctly. You can make huge profits by investing in the right growth stock at the right time. Some good examples of growth stocks include Amazon, Facebook, and Tesla. All of these companies are in the technology sector and are known for their high growth potential. Look at Amazon, for example. Amazon is the prime example of a growth stock. In 1997, Amazon stock was valued at 9 cents per share, and today, it's valued at $94.14 per share. This means that if you invested $9 and bought 100 shares of Amazon in 1997, then almost 25 years later, your $9 investment would have grown to $9,414. Facebook is another common growth stock. Its share price in 2012 was around $38, and today it's valued at $112. So if you bought 100 shares of Facebook in 2012 for around $3,800, your money would now be worth $11,200 today. That's more than triple your money in 10 years. There are a few things you need to look for when trying to find growth stocks. The most important thing is to find companies with good fundamentals and good leadership. This means looking at things like the company's revenue, earnings, cash flow, and profit margins. You also want to look at the company's growth potential. What sector is the company involved in? What products do they make? Tesla, for example, makes electric cars. Now, I think we can all agree that electric cars are only going to become more and more popular over time. But 10 years ago, when Tesla first started, no one really cared about electric cars, and none of the other big car brands were even looking to build them. So, try to find companies that are paving the way in their sector and building innovative products. If you can spot one of these companies early, you can make some incredible returns. Okay, now let's go over the pros and cons of growth investing. Pros of growth investing? Well, the main pro is obviously the high returns you can expect to make if you invest into good growth stocks. You will also be investing in new companies that could literally change the world. This in itself can be pretty exciting to be a part of. Another pro is that you won't have to pay tax on your investment gains unless you sell, unlike dividend stocks, which will be taxed every time you receive a dividend payment. Cons of growth investing? The main con with growth investing is the high amount of risk and the fact that it can be difficult to find good growth stocks that will actually succeed in the long run. Growth stocks also tend to be extremely volatile. This means that the stock price can go up or down significantly in a short amount of time. A lot of investors won't be able to handle these large swings in price, which will lead them to selling their positions due to panic. So, who would suit growth investing? Growth investing is a high-risk, high-reward strategy that may not be suitable for someone looking for stability and consistent returns. For those who are more adventurous and looking for high returns, though, growth investing can be an attractive option. It makes sense for people in their 20s or 30s to invest in growth stocks, because when you're young, you can afford to take more risks, and you'll have more time for your investment to grow. However, if you're closer to retirement, it may be a bad idea, because if you invest in bad growth stocks, you could end up losing a large portion of your savings right before you retire. To sum it all up, ultimately it depends on your goals, age, and risk tolerance. Dividend investing is often preferred by older investors who are looking for income and stability, while growth investing is often preferred by younger investors who have a higher risk tolerance. Both strategies have the potential for high returns, but they will suit different types of investors depending on what their goals are. It's important to understand your own investment goals and choose the strategy that is right for you. A good rule of thumb is to have a mix of both strategies so that you can benefit from both dividend income and growth potential. Whatever route you decide to take, make sure you do your research and understand the level of risk associated with each investment style. Which approach do you think is best? Let us know in the comments section below. As always, I hope you enjoyed today's video, and I'll see you in the next one.